The bond market has taken center stage for investors as uncertainty about trade and the economy rise. Joining us now to discuss the outlook for the fixed income space and the roles these assets can play in a portfolio is our bond market panel. Alexandra Gorewicz, Vice President and Director for Active Fixed Income Portfolio, TD Asset Management, joins us now. Rachana, Bhat, Vice President, Director and Lead for Investment Grade Portfolio Management at TD Asset Management. And Anthony Imbesi, Vice President, Director and Lead for High Yield Portfolio Management with TD Asset Management. And thank you all for joining us. I think this is a first bond panel on Money Talk Live, so thank you for joining us on this show. We've seen a lot of uncertainty, a lot of volatility over the past few days. Alex, talk to us about what you've seen and sort of what's driving the bond markets.
Well, Tony, I wish I could give you a really, comprehensive answer. I mean, I think you can realize from the frequency with which U.S. trade policy changes are being announced, day to day, sometimes, hour to hour. It makes it really difficult to have a really good grasp on what the bond market is saying and what it's pricing across a whole host of, we'll call it, economic indicators. The most concise way that I could summarize is that the bond market is really hyper-tuned right now to the weak sentiment on growth in particular that we see in both business and consumer surveys. So the bond market is worried that there are downside risks to U.S. growth as well as global growth. But there are a lot of competing narratives that actually make it really hard to say with certainty that the bond market is pricing a recession or that it's pricing inflation or that it's pricing stagflation or soft landing. I mean, it's not really pricing any one of these things. So I'll give you a couple of examples. On growth, there are a lot of people who say that the longer these tariffs stay in place or the longer the uncertainty around tariffs stay in place, the more likely it is that a recession can happen in the US and globally. But the bond market's only pricing 3 Fed cuts to the end of this year. We came into this year pricing 1 versus 3, not a material difference, certainly not pricing recession. If we look on inflation, there are some who say that the reason we don't price more Fed cuts for this year is because tariffs are expected to induce inflation. And in fact, if we look at those survey indicators, we do see a lot of inflation expectations rising, although I would caution there's a lot of partisan bias in that. But what is the bond market saying? Well, the bond market, if we look at either bonds or swaps that are linked to inflation pricing, they're saying inflation could rise or will rise this year and possibly next year. But beyond that, when we look at 5-year, 10-year, 30-year inflation expectations, they've actually all collapsed. So really what the bond market is saying is maybe near-term inflation pressures, but longer-term, certainly disinflation, possibly even more if we get a recession. So again, there's nothing clear in terms of any one of the sort of competing narratives in terms of what the bond market is signaling. In Canada, it's a little bit of a cleaner, we'll call it narrative, because we have a head start on the rest of the world in terms of dealing with U.S. trade policy uncertainty, and so much so that it's actually resulted in job losses in March. Bank of Canada has cut 2 times so far this year, but even there, when we look forward, bond market's only expecting 1, if maybe 2 more Bank of Canada rate cuts. Again, not screaming recession. Now, we're also in the middle of an election, and whether it's investors or the Bank of Canada, I think everybody's waiting to see what kind of fiscal support or fiscal stimulus will come out post-election, and that has to be obviously factored into economic forecasts. But so far, the bond market, even here at home, is in limbo.
Okay, so given that backdrop, Rachana, how about investment grade? How's that holding up in this sort of weaker growth environment?
Sure, and let's start with what Alex highlighted, which was that we're operating in an economy where the risks are above average, both in terms of inflation concerns and growth concerns, really being driven by the uncertainty around tariffs. So you've seen all risk assets reprice and adjust to this backdrop. Some have moved more than the others. Now, when you turn to the corporate bond market, one of the key valuation tools we look at is spreads. Spreads are the extra yield or the extra compensation you earn when investing in a corporate bond over a government bond because you're taking on additional risk. And when I say spreads are widening or going up, it's the same thing as saying equities are falling, which means it's a bad thing, and vice versa. So spreads tightening or spreads falling is a good thing. Now, when you look at the moves in the IG land, investment grade land, year to date, the spread move has been pretty decent. But it's important to keep a perspective to how these spreads have moved historically. And if you look at history and look at current spreads, we're still tighter than long-term averages even in both the US and Canada. So when you align this with the fact that the economy is still seeing above average risks, the valuation doesn't align well still. So our view is the peak in spreads is still ahead of us. But that peak is likely going to be lower than previous recessions. So let's call it a major widening event where spreads blow out and spreads sustain at those high levels is a very unlikely event at this time. And there are a few factors that are providing the offset, and it's important to understand those factors. So the three key factors are, the first one is demand. So yields are very attractive from how they are historically and where they stand today. So when you look at yields, the income that you're earning on bonds, it's at levels you've not seen in many, many years. And that's drawing strong interest from buyers. All they need is for this volatility to subside. The second factor is supply hasn't kept up with this demand. Even so, more so this year, because of the uncertainty, companies have been hesitant to come into this issue in this environment. M&A has been quiet. And M&A typically brings more supply. So the supply hasn't kept up with demand. The third factor, credit fundamentals. I mean, they're very solid going into this uncertainty. So when you have, and one of the examples I would provide for credit fundamentals is, if you look at the riskiest part of the IG market, which is BBB minus rated credits, those are at their lowest share in the IG market than they've been in the last 25 years. So you've seen these factors support market momentum in real time. So last week, when we saw a very strong risk-off sentiment, you saw spreads widen a lot. But the move tighter after was just as forceful. And that's a sign of how much cash there is on the sidelines waiting for an opportunity. And that needs attention. We need to pay attention to that. So as we sit here today, we do believe that spreads need to reprice fairly still. So they need to widen more. But the setup doesn't point to a disorderly blowout in the investment grade land. And it is in these moments of dislocation where some of the best, call it long-term opportunities, quietly start to build. And our teams are very focused on finding those opportunities at this time.
Okay, Anthony, Rachana pointed out to the yields, spreading out. What's the impact on the high yield market? What's been happening there?
Yeah, there are a lot of similarities to what Rachana was talking to, but I think your opening line pretty much summed it up. There's a lot of uncertainty and a lot of volatility, and that's what we're seeing in the high yield market right now. Investors are finding it very challenging to digest, process the constantly changing information that they're getting on tariffs, which makes it pretty challenging to assess credit valuations. The high yield market has sold off in light of the announcements of the tariffs, to no surprise. I think what we're seeing is the most of the sell-off is coming from the lower quality, higher risk companies. So these are the companies that have the most leverage, so the highest levels of debt on their balance sheet, most exposed to tariffs or consumer discretionary spending. And the longer the uncertainty of tariffs continues, the more that will be reflected in economic growth, potential higher risk of recession, and ultimately that gets reflected in deteriorating earnings, corporate earnings, which are a big driver of high yield credit performance. In terms of the valuations that we're seeing in high yield right now, again, Rachana spoke about spreads. High yield is the same thing. We talk about spreads when we're talking about valuations in high yield. And it's just really the difference in yield between high yield bonds and government bonds. So it's the premium that investors demand in order to lend money to these companies that have lower ratings than government bonds. And what we've seen is spreads have widened quite significantly. At the worst point, they were wider than 100 basis points, which is probably the worst widening we've seen going back to COVID, back in March 2020. They widened to about 460 basis points. Today, they're sitting at about 425. And for context, I would say, if you look at the post-global financial crisis, spreads have averaged about 450 basis points. So we're inside of that, which, again, doesn't really indicate things are that bad. The other indicator is, and high-yield spreads are usually a good indicator of when recessions are going to come. We need to get to about 700 basis points before we really start to get into recession territory.
We're nowhere close to that right now.
Nowhere close to that, and that's also encouraging. And I guess the final thing I can say is, if we go back to March, just before all this tariff announcements, yields were about 7.5% on average for high yield. Today they're sitting at 8.5%. So they've widened a bit, looking more compelling. Could go higher. Again, we're probably not at the bottom right, or at the peak right now, but it's just something to keep in mind when looking at high yield.
Yeah, that historical perspective is very comforting with respect to these spreads. So with that environment, what role can the different classes of bonds play right now? And Alex, we'll start with you.
Well, and this is really an extension of what you've heard from both Rachana and Anthony, and that is that we're not, signaling recession, across the bond market or across bond asset classes. And as a result of that, I would just say investors need to be very cautious about taking longer U.S. duration risk. And when I say longer U.S. duration risk, so I started off by telling you that the bond market is hyper-tuned to that weak sentiment, and you have seen 2-year and 5-year bond yields come down relative to where they were, say, at the start of this year when everybody thought soft landing, here we come, right? 10-year and 30-year bond yields, though, might surprise a lot of people. They're plus or minus unchanged from where we were at the start of the year. And we think that's fair when you take into account that, again, inflation fears have not yet resulted in strong CPI prints in the US. Growth fears have not yet translated into negative labor or job losses accumulating. And so the bond market is really stuck between a rock and a hard place. But then when it comes to US government bonds specifically, and again, looking at longer dated bonds, you're now compounding it with the additional concerns around fiscal sustainability. We're closely monitoring the budget bill and how it's working its way through Congress. We have to see what kind of spending cuts are ultimately going to be incorporated into the final bill. But right now, we'll call it part of the budget resolution process, I see trillions of dollars worth of permanent income tax cuts. I see only a paltry few billion worth of government spending cuts. We need to see a lot more balance there. Otherwise, I think investors will be worried about U.S. debt sustainability, and that will impact longer dated interest rates in the U.S. bond market.
And Rachana, maybe I'll pass it to you next. Talk about how investment-grade bonds, what role they play as an asset class.
Yeah, sure. So we spoke about an environment where yields are high historically. Credit spreads can still widen a bit more from where they are today. And we also established that technicals, which is the supply and demand aspect of the investment grade or high grade market, is in good shape. So when you put all of those things together, what you want to do is you want to be earning those yields. So you want to be earning that income. But you don't want to be taking too much risk at this time in terms of credit risk and interest rate risk, as Alex highlighted before. There is a lot of uncertainty out there. So you want to avoid long-term corporate bonds, and you want to avoid fundamentally weaker credits, because the price loss there will be much more when the markets get choppy again. So what you want to do instead is you focus on short-term corporate bonds, which allow you to earn the income, but it's not too long in terms of duration or tenor of the bond itself, where your price loss will be substantial. So short-term corporate bonds have decent cushion in how much income you generate, and that income is able to nicely offset some of the price loss you might get in a situation where markets are choppy again. And we believe that at this time, what might make sense is focusing a little more on Canadian corporate bonds. The reason being, our economy has more monetary and fiscal policy room to provide some offset. That's probably not as much in the US just yet. So short-term corporate bonds, 5-year and under, focusing on Canadian corporate bonds from a tactical standpoint is how I believe investment grade can fit within diversified portfolios.
And Anthony, what should investors be focused on in the high yield market?
Well, the high yield market is, I would say the most effective way to use high yield is to include it as part of your fixed income solutions. So to what Alex and Rachana just said, if you add high yield to a fixed income portfolio of just traditional government bonds and investment grade bonds, you'll add diversification, you're adding obviously higher yield, just to get compensated for the credit risk, you're lowering the correlation of your portfolio. Naturally, high yield has a lower duration than investment grade. The bonds they have maximum 10-year maturity and they're callable. So you're lowering the duration of your portfolio. If you include loans, you can lower that further. Loans don't have interest rate exposure as the coupons reset every 3 months. But also, it's a big market, 1.3 trillion in size for the high yield bond market and for the leveraged loan market. You can diversify across many industries. And yeah, ultimately, if you have a long-term view, you can take advantage of these yields or returns, because if you think about it, if you go back 25 years, the average annual return on high yield is just under 7%. And it's hard to get that in government bonds and investment grade bonds alone. So it's a great complement to that. And I guess I would say, that pretty much sums it up.